Every price tag you read right now, every bill you pay, every single cent in your bank, all of it is tied to one number. And that number is at the brink of cracking. The world is standing at the very edge of a threshold we haven't seen in 80 years. And this isn't coming from a conspiracy theorist. It's coming from math. Hard, cold, ruthless math. Because the entire global financial system is built on a single assumption that is now starting to break. The assumption that U.S. Treasury bonds will always find a buyer. I know that sounds technical, but listen closely because it affects you directly, your mortgage, your job, your retirement, your child's future, and where you will stand in the middle of what could be the biggest economic collapse of this century. This video isn't to scare you. It's to prepare you. The United States currently has $38 trillion in debt. Take a second and let that number land. 38 trillion. Roughly equal to about 40% of global GDP. And that debt keeps growing by about $2 trillion every year. Where does the government get this money? By selling bonds. By borrowing new debt to pay old debt. Like paying off one credit card with another credit card. As of 2026, the U.S. Treasury is issuing $8 to $9 trillion in new bonds annually. That's about $25 billion every single day. Every day, including weekends, including holidays, including Election Day. This system can only function if buyers keep showing up. Foreign central banks, institutional investors, insurance funds, pension funds, the Federal Reserve, all of them must systematically buy these bonds. Repeatedly. Reliably. Every week, every month, every year. But what if one day they don't? That's the day everything changes. The U.S. Treasury sells every bond through auctions. If demand is strong, yields stay low and the government borrows cheaply. If demand weakens, the government is forced to pay higher interest. The 10-year Treasury yield is currently around 4.2%. It looks like a single rate, but it isn't. That rate sets mortgage rates all over the world. It shapes corporate borrowing costs. It affects stock valuations. It decides whether millions of small businesses survive or fail. It determines whether a factory worker keeps their job or gets laid off. What happens if that rate rises to 5%, 6%, 7%? Mortgage payments nearly double. Companies can't borrow, investments stall. Factories close, layoffs begin to spread. The stock market crashes. And worst of all, the government's interest bill swells so much that a major portion of new borrowing starts going toward paying interest on old debt. That's what they call a debt spiral. And once it begins, it's almost impossible to stop. Because more debt means higher rate. Higher rates mean bigger deficit. Bigger deficits mean more borrowing. And the cycle feeds itself. You might be thinking right now, that's America's problem. How does it affect me? It affects you in every way. Directly, concretely, unavoidably. Because the dollar is still the world's reserve currency. Oil is bought and sold in dollars. Most global trade happens in dollars. Banks, pension funds, and central banks across the planet hold trillions of dollars in U.S. treasuries. When the U.S. Treasury market shakes, a Japanese bank in Tokyo shakes too. A German pension fund in Frankfurt shakes too. A factory owner in Shanghai shakes too. A farmer in Lagos shakes too. A small business owner in Istanbul shakes too. A middle-class family in Sao Paulo shakes too. This system is global. And if it breaks, it will break globally. No economy, no country, no bank can remain isolated from that storm, because everyone is standing on the same foundation. And here's the real danger signal. The early warning signs are already visible, but most people don't know how to read them. In recent months, the bid-to-cover ratios that measure demand in bond auctions have been falling. For a strong auction, that ratio needs to be above 2.5. Recent auctions have been closing at 2.1, 2.2, still sufficient, but unsettling. The share of foreign buyers is shrinking. For much of history, foreign participation hovered between 60% and 70%. Now it has fallen to 55%. It looks like a small drop, but on a global scale it means billions of dollars retreating. China reduced its Treasury holdings from 1.1 trillion to 800 billion and continues buying gold. Japan isn't increasing its holdings, and it's struggling with its own domestic debt problems. Middle Eastern oil revenues are flowing not into treasuries, but into gold, infrastructure investments, and alternative assets. Russia has fully exited U.S. treasuries since 2022. So the foreign demand that was historically guaranteed is no longer guaranteed. And there is no ready, deep, reliable pool of buyers waiting to fill that massive gap. There wasn't, and there still isn't. So will this trigger the disaster right now? Maybe not. But maybe yes. And the uncertainty itself is a risk. The system becomes more fragile every day. The political capacity to produce solutions is essentially zero. Republicans want tax cuts, Democrats want more spending. Both expand the deficit. According to the Budget Office projections, U.S. debt will reach 140% of GDP by 2030 and 180% by 2040. Any bond buyer looking at those numbers asks one question: how will this debt be paid? There is no answer. Because there is no answer. And that's why a single bad auction could be enough. A Tuesday morning where the bid-to-cover ratio drops below 1.8. An auction where demand comes in far below expectations, and yields instantly jump by half a point. From that moment on, dominoes start falling within hours. Bond markets collapse. Rates surge upward. Stocks open with sharp declines. Credit markets freeze. Banks stop lending to each other. Companies can't raise capital. The central bank faces an impossible choice: either let the economy collapse or print money and destroy the currency. Both are painful. Neither is inevitable, but both are possible. And while that decision is being made, the world waits, markets wait, and you wait. No one knows exactly when this scenario will happen. Maybe not soon. Maybe a few years from now. But the conditions are in place. The fuel has piled up. The ground is dry. All that's missing is a spark. And if you look at history, sparks always come at the most unexpected moment, from the most unexpected place. In 2008, nobody saw Lehman coming. In 2020, nobody expected the pandemic. The next crisis will arrive the same way, quietly, suddenly, crushing those who aren't ready. Before that spark strikes, we'll talk step by step in the next video about what you should do, how to position your portfolio, and which assets tend to gain value in this kind of storm. But the most important thing you can do right now is this. Watching this video isn't enough. You need to understand it. Because the people who understand this now will be the ones who are ready when that day comes. Send this video to someone who cares about their financial future, a friend, a family member, a business partner. Because when this storm hits the door, a lot of people will think, "I wish I had known earlier." I hope you're not one of them. Don't forget to like the video and subscribe. Thanks for watching.